So I think the question that we're all here to answer is this first one is sort of, does DPI change the world, right? And I would argue that, of course, it already has in India. If you look at all the evidence of the rate of accelerated banking penetration, which the BIS argues, what should have taken 50 years of progress in financial inclusion actually took about a decade in India. It's clear that it changed the world for India, right? It drove formalization. I think this question of could it change the world differently came to my mind when we were listening in the morning to the conversations led by Dr. Anindya Ghosh as well, um, on, hey, if we'd actually had an interoperable protocol for messaging, WhatsApp wouldn't even have become a big monopoly, right? In that sense, if we had done in internet-based messaging what we did in email and what we did in text messaging, which is to create a unified standard called SMS or SMTP that allowed us to communicate regardless of which device we used, some of these questions around competition and economic outcomes are so dependent on the kind of technology architectures that we choose or don't choose, right? And I think it was really obvious after India pioneered some of the DPI movement and brought it to the world in the G20 in 2023 that this was something that the world could reuse. And so I want to talk to you a little bit about where we are coming from at the Center for DPI, the work that we do to take this work forward, and what we've observed about the way DPI is different to other kinds of infrastructures. I think it's very easy to confuse it with e-governance. It's very easy to confuse it with any population scale technology. So what are we really kind of talking about, right? I think, yeah. So just to give you a small bit of background, Center for DPI is a global pro bono advisory team. We're housed in an academic institution at IIIT Bangalore. But we offer pro bono advisory to countries around the world on technology architecture, specifically for DPI. So we work all around the world. Those purple dots are countries that we've engaged with. Over 25 technical blueprints, and 7 of these countries are building at national scale. It's not just about India anymore. This is a truly global kind of movement. And so we crafted sort of a global team to drive this work forward. What we've observed is that DPI is not it's always evolving. So the infrastructures that we've built in India aren't even exactly replicable, right? In other contexts are going to take different aspects of the learnings and evolve it institutionally. And so some of these countries that you see are doing in some ways slightly more advanced versions of DigiLocker or Aadhaar or payments infrastructure. So the way that we frame it is that DPI is actually not a category of software, which it's often confused to be. It's a set of design choices. And what does that mean? It means that whatever you build is reusable by somebody else. It means that if you have a set of services, you have open APIs. It means that you're interoperable. That means the customer can choose and switch easily. We heard earlier about switching costs, can switch easily from one to another without a huge degree of friction or a huge amount of money left behind or a huge amount of data left behind. It means that what you're building is minimalist and evolves over time. It's federated. It, of course, preserves privacy and security. It drives inclusion, but it drives inclusion in a very specific way, which is to allow for many modes of access and not restrict yourself to, let's say, a single government portal, right? That actually we would characterize as not on its way to being a DPI, but not there yet. So how do we recognize DPI when you see it? I think one of the core questions that we'll ask, as we're trying to study the impact of this, is really what's going to distinguish your average your typical e-government implementation from a really powerful digital infrastructure that drives this economic growth that we've heard about, right? On identity, the way we talk about it is it needs to be verifiable. It needs to be authenticated. It needs to be multimodal. It needs to cover everyone in the country. So if you have an identity system, that covers 30% of the population and is just a card that the person has to physically show, that's not a DPI, right? But we can move it towards that by making a series of changes. A second, of course, category of infrastructure is in payments. And around the world, we see lots of countries pointing out their payments as digital infrastructure. And we usually point out back to them that although Visa is a digital payment system. We don't classify it as a DPI in India. And the reason for that is because it doesn't reach the small mango street seller on the road with an inclusive multimodal mechanism to make that payment. So these are sort of characteristics that we should keep in mind when we're evaluating. Same with sort of data sharing, and the most controversial, I suppose, is government services, right? So we heard, this morning about a series of government platforms and portals that are all powerful in that they are single windows, right, of access, but that in and of itself doesn't make it a DPI. In our view, it has to do more than that. It has to actually unlock open APIs to allow many private players to build custom user interfaces to interact with that same portal so that you truly galvanize private innovation. Which brings us to this framing that Manish hinted at in the morning too, which is that implementing DPI is not just about tech. It's not about writing the right protocol or having the right standards. It's about making sure that you have all three layers, which is the technology layer, the policy layer, which means you have governance sort of set up right in an institution that can take the work forward, and you have crucially market innovation that's unlocked as a result of implementing the DPI. If we're building digital platforms in silos and it's just between three departments talking to each other, that's really powerful for e-governance. It's not DPI. So for it to be truly infrastructure, our contentious statement is that if there's no private body that's benefiting from accessing what you've built and can build a better good or service that reaches the customer at the end, it's not meeting the bar of what infrastructure is. And of course, all of the infrastructure that we build goes through a journey to get to the optimum state. But we wanted to raise this as sort of a key flag as you're thinking about what to measure in terms of driving impact. I just updated this slide last night. This is like the new India stack. The old India stack used to just be three layers of Aadhaar, UPI, and a DigiLocker. And slowly we've evolved it from different aspects of verifiable identities that cover different functional framing. So a goods and services tax ID, GSTN, gives 10 million businesses a verifiable proof that they are a business and this is their turnover and this is their address, right? Which helps them in a variety of private contexts on an e-commerce portal or in a government compliance. Similarly, you have a health identity, you have an Udyam, which is a SME identity, you have a farmer ID, and all of these crucially are not just cards, they're evolving to be verifiable in a digital manner by a private ecosystem. Similarly, for payments, this is the one everyone knows. Everyone thinks of UPI, but there's so many more payments building blocks that India has, right? You have Bharat Bill Pay, which unifies bill payments across electricity, utilities, schools, lenders. Any kind of bill that's represented is actually fetchable on any app in this country, right? And it's quite remarkable. Usually, this is left to a portal or siloed by sector. But similarly, you have the two government-to-person payments rails, which is Aadhaar Payment Bridge, APB, which is housed by NPCI. It's commonly known as the Direct Benefit Transfer Program, but behind the program, the infrastructure is Aadhaar Payment Bridge, and Aadhaar Pay, which is the ability to withdraw cash using your fingerprint. These are all separate individual Lego pieces that have been combined. And this also brings the question to us of why it's so hard to measure the impact of DPI, right? We've had DPI around for 10, 15 years. Why haven't there been more studies that truly, if we know we know looking out at the streets that it's been impactful, but it's hard to quantify. And the challenge here is that you have so many of these individual Lego blocks in different categories that are working together. And so determining causality is the job in front of you as economists, I think, to say, how can we actually look at the effect of any of these individually, but how can we look at the effect of all of these together? So I'll give you an example of a Figma demo screen of what a loan looks like, which is the classic example of a full use case that combines many of these blocks coming together. So when you start in one of these screens, you start by saying, okay, look, I'm going to share my data using account aggregator. And so in that, imagine you're doing a loan sort of with HDFC Bank, but your data is sitting with ICICI Bank. So you go through the account aggregator flow to begin the process of sharing your bank statements. You connect your accounts, you do your OTPs. OTPs are insecure, but they're so powerful for inclusion. What other authentication mechanism could you use that actually reaches the farmer in a remote village, right? So you can let's say you're able to customize a loan offer, receive a final loan offer, and then it triggers you through these many sort of steps. But the interesting thing is that all of these steps would have taken, let's say, 30 days before this infrastructure came into place. All of the building blocks that I showed you on the slide before, offered by a bunch of different institutions in the country. It's not like there's a DPI Ministry of India, right, that's offering all of these. But the different institutions are able to offer reusable building blocks, which allows composability on the private sector side. So they can combine these building blocks and move together. So I think moving forward, the ways that we're seeing, and we're not economists, you'll have to tell us this, but as practitioners, what we see on the effect on the macroeconomy, first, of course, is formalization. The degree to which you can now bring someone in as a participant into a digital economy is entirely different, because they were able to open bank accounts through Jandhan, they're able to transact digitally using UPI, and they're able to share their government data using DigiLocker. But what we also see is a higher velocity of digital transactions because of the ease with which this is possible. And this is some of Shashwat's work. I'm sure he'll cover this in a little while. The other routes that we see are ease of doing business for small firms. I think the open APIs for government services available via API Setu, which some of the work, again, Manish has been driving within different committees. All of this allow for a lower operating cost for a small business, which has tremendous trigger-on multiplier effects in an economy. And the last one, which is unpopular, is and sort of not as well known, is this idea that DPI actually makes your monetary policy more effective. Although we'd argue how effective it is. The reason is because all of monetary policy is predicated by how many people are actually in the formal credit market ecosystem. If you bring in more into the share of the pie, the number of people that benefit from an RBI repo rate cut is changed in the tune of tens of millions, right? So the power actually of DPI and second order effects on efficacy of policy making, hasn't been studied at all, and could also be explored as a final sort of route. Sorry. So I would argue that the one thing that we shouldn't do in India is rest on our laurels, right? DPI is now a good 10 years in the making, right? It started, as Suresh pointed out, in the morning in 2010. We're in 2026, right? So we do need to look forward and not just look backward. Yes, Aadhaar and UPI were well designed, so was DigiLocker, but there's a lot that needs to be done to push adoption beyond just put the infrastructure out there. Because if you have a protocol out there and it's not adopted, you might as well have not put out the protocol, right? So for some of these infrastructures like account aggregator, unified energy interface, API Setu has been in the government parlance for nearly a decade by itself, and it's still not even close to 50% coverage of all government services that are available on API Setu. So if it's so obvious that DPI drives economic growth, these initiatives need to be prioritized more across government. And our hope is that if there's more research out there to support this thesis, that maybe that process becomes easier for governments to do that math. So there's, in addition to sort of pushing adoption of current blocks, we have to think through additional improvements around, speaking to the last session, voice and local language. How do we incorporate this natively within a flow like an account aggregator or a DigiLocker, or a UPI for that matter? Although Hello UPI was launched 4 years ago, we haven't seen its traction pick up because there's not been enough iteration, I would say, on it, and incorporation of Hello UPI in local languages. So there's a lot of work that's yet to be done on even in India, on strengthening the DPI ecosystem, and of course advancing the thinking into new areas like energy. I would argue that building a DPI for energy is about the most important thing you can do for AI in the country. Because AI growth will be predicated and constrained by the cost of energy. And in India, we are failing at energy delivery at current demand. So I think thinking through DPI initiatives for other sectors is also going to be crucial. Bringing us to the thought of, like, how do you frame DPI and AI? Of course, these are two huge buckets, so it's very hard to come up with one cumulative framing. But there's a couple of notes that I'd like to share. First, AI makes DPI sharper, which means anytime you use sort of a fuzzy name match, a better model behind your video KYC, or real-time fraud reduction in payments, all of these are simple AI models, right? They don't have to be as sophisticated, which I think even, Dr. Ghosh and Ravi talked about in your book as well. These models help make DPI systems better, more inclusive, and that's already been happening, right? It's happening with UIDI and others. AI in turn makes DPI more inclusive, which means, because of the voice models, because of the innovations in access, you can actually reach more people that don't have to go through complicated flows, right? The entire UPI architecture was predicated on ease of user experience. If you don't need to worry about ease of user experience, you could think of completely different DPI flows, in fact, right? That don't have to optimize for how a person clicks through screens if they're using a voice-based agent, right? DPI also makes AI safer at scale. I would argue that countries that don't have the open API architecture that India has will find it harder for agents to operate in their ecosystem. Like if you have an open API, that agent goes through that route rather than screen scraping your data, taking your password, and then going rogue and you have no ability to kind of control it. So I think in some, there's a bunch of open questions that are worth measuring, which you will all be better at framing than some of us. But the answer to the question of does DPI change the world is yes, but please prove that it does. All right, thank you.
Good afternoon, everybody. 18 September 2009 was when, as part of UIDI, we did our first outreach to a think tank, NCAER. Mr. Suman Berry was the Director General. And the kind of questions we got from that room of economists, right? Uh, some of them we still don't have answers to 17 years later. But it was that intellectual stimuli, right? That you're not just going to build out an identity system, you're building something far bigger. So the consequences of that are big. The economic perspective gave us a good window into that. October of that year, a certain Professor Ravi Bapna reached out to us saying that I hear you guys are doing some big hairy stuff. I'm interested in this. Can I talk to you guys? Full 6 months before Aadhaar was even named. The point is, whether it is UID, Aadhaar, or UPI, they were started with a clear policy objective in mind. The original brief to Nandan was to develop unique identity. Digital was not even mentioned. Just because it did not say digital, he said, yeah, it does not say not digital, so I'm going to do it digital. Uh, and that succeeded. UPI succeeded. So around 2017, people started to ask the question, this thing you guys keep doing again and again, what is it? Uh, It is Aadhaar, it is UPI, it is that. No, it has to be something because you're repeating some algorithm. Yeah, I guess. And then couple of years later, that had to be given a name, digital public infrastructure. Why infrastructure? Because technology people either love or hate. But infrastructure, how do you hate infrastructure, right? So therefore infrastructure, right? Digital, yeah, easy. Public. The grief I get from economists, you should not have called it public because public goods are whatever, the three things that I keep hearing again. Irrefute, whatever was it? Yeah, those three things. Like it irritates the hell out of me. Right? Guys, we were not economists when we named it, right? So just cut us some slack. Focus on what the rat trap does. Don't focus on the rat trap itself. So what is DPI? I don't have to educate to this room. And the idea that you can bring about large scale policy goals non-linearly is what well-designed DPI does. First point, the starting point is always a policy goal, never technology, never DPI. When you work backwards, as Kamya said, there's a way to design for it, there's a way to leverage technology, And if you follow the right principles, that roughly might be what DPI looks like. But DPI is never the point. It's the means. The point is always you're trying to reduce direct benefit transfer, you're trying to improve inclusion of the financial sector. That is always the starting point. And that is what the better designed DPIs have done in India. We are now in 2026. DPI has done a lot for India. All the laurels are there. There are some skeletons also nicely buried of some DPIs that did not work well. That's great. But we need to move on. So recently there was a report released, and I'm sure the NCR teams will share with you what you're calling as DPI at 2047. Some of the best thinkers on DPI came together to put their collective thinking. Kamya CDPI, a whole lot of people from Bangalore, Delhi, all around who've been part of this. So in that we called out two phases, DPI 2.0. So the last 15 odd years we called it DPI 1.0 to differentiate it from DPI 2.0. And then we call it DPI 3.0. I'll keep aside for now. What we said was DPI 1.0 was primarily around welfare distribution. The government got public rails to reach 1.4 billion people with a focus on welfare, direct benefit leakage, transfer, reduction, etc. And you know the statistics on that. So in 2026, that approach is not enough. India wants to be a developed nation by 2047. We need non-linear growth. None of the current efforts can ever get us there. But if you look at DPI from the lens of non-linear growth, therefore the role of DPI 2.0 has to grow from welfare distribution to distributed wealth creation. If we are to achieve our $18,000 per capita income to be a developed country, that is incredibly hard. So we have to take it from welfare to economic opportunity. We have to have it solved not just for the government's duty of welfare, but for the citizens' goal of aspirations. They are meeting their aspirations. So loosely, if DPI 1.0 moved identity, moved money, moved documents through public rails and private innovation, what does DPI 2.0 have to move? What is the locus of action of DPI 2.0? These were some of the questions we wrestled with. And several of these, what I'm talking to you, are things in flight. It's early days. It's the equivalent of 2009, 10 or 2015, 16. Right? So these are early days. And that's why I would encourage those interested to engage in it, reach out. There are several initiatives going on, and not wait till 5 years when some project is a success or not, because the questions you ask are the kind of questions we need to create the guardrails to make sure India is headed in the right direction. So what is DPI 2.0 about? Through DPI 1.0, we solved for financial inclusion. There's a bank account for a farmer. But how does a farmer, 80% of India is small, 85% is smallholder farmers, average income of 4,436. How do they increase their income? They need access to the right inputs. When should I harvest? What kind of pesticide should I use? They need access to markets. They need access to credit. How do they get that? A young boy skilled in something wants a job. A young girl wanting to study higher needs scholarship. If you think of it, all of these are a myriad of problems. But the DPI approach there means we go back to, as Kamya said, what could be some common building blocks? To flip it around, what are some common frictions that we see across, which we can abstract into those building blocks? Turns out, like with DPI 1.0, there are not too many. Kamya already covered a lot, but discovery is one huge thing. Discovery of markets, discovery of jobs, discovery of skilling centers, even discovery of that girl who needs scholarship. In an age when a taxi finds you, a pizza finds you on your phone, Why should a girl be searching for a scholarship? Why shouldn't the scholarship be searching for the girl? Why shouldn't the scholarship find the girl who's saying, I need financial help? You go there, press a button, and a ping goes, and taxis converge on you. Can we do that with those who need help from schemes? That's one imagination. Can the farmer get advisory in their own language, contextual to them, not generic stuff like tomorrow's weather is great? I am Ravi Yadav. This is my land. These are my crops, which the government knows because of Agri Stack, which is one of the DPI 1.0 constructs. So when the government knows that, why should the government not be able to provide information saying, Ravi, this is what you're planting this time. Here is where the inventory, you can store it. This is what the pricing looks like. In Marathi, delivered over a feature phone, not a smartphone, not an app. It's conversational. Why should we be constrained by the limitations of the interface, the language? And that is what is happening in agriculture, already happening. So, discovery, trust. Once I discover a boy who has credentials of from a certain skill in college, how do I trust that? It's not those of you who've used Digi Yatra to access airports, it's the same thing. My data is in different parts of government. You guys sort your mess out. Don't put your inefficiencies on me. Those who have used Digi Yatra know that, right? You have my identity data, you have my ticket data. Talk to each other and let me through. Some of these, it's only when you see the possibilities do you realize what were we thinking before this. Those who have used UPI, Manish, some of us, less younger people, the days of going to a bank account and teller and cash, it looks quaint, right? But that's the journey we have made. DPI 2.0 is making the next set of those things, taking DPI principles and, as Kamya said, having AI as a complementary thing. India has the advantage because we have those DPI rails. So AI can very quickly reach 1 billion plus people. And because of AI, DPI gets better. And because of DPI thinking, we can implement AI in a different manner. So I talked to you about agriculture. I spoke to you about discovery in its myriad ways. Third, small businesses. They are struggling to find markets. They're struggling to find a few people who they need to employ. They're struggling to comply with government norms. They're struggling to get credit. Why is that? So there's a lot of effort happening there to unlock the MSME stuff. Of course, education, education and health are also crucial, and therefore that is anyway happening. And another set of three, Kamya covered one of them, energy. How can I transact in energy the same way I do in UPI? That's some powerful efforts already happening. I told you about benefits, finding beneficiaries, and easier credit. So there are 8 of these sectoral transformations that we are looking at as a country, and DPI 2.0 covers that. Essentially, doing that by not solving each problem one by one, but by figuring out the underlying frictions and solving for that. We talk of access. What good is access if I'm not able to participate in that? Voice, AI, my language, conversation, all data connected with my consent allows me to participate, express my intent, express my conditions, have various discussions, and still do it in a way that India does not need to get formalized like in the developed countries. Using this DPI and AI construct, we can improve our capability, human capability, improve our productivity, thus resulting in a much higher output economy. So the path India can follow need not be exactly the same as that in other countries, like the way we did with financial inclusion. So it's early days, it's exciting. It's as exciting as 2009 when we thought we would change the world with UIDI. etc. Except now the challenge is much harder. The urgency is much more. The asking rate, those of you follow cricket, is much steeper. And we cannot do it one by one. One Aadhaar, one UPI, one DigiLocker. It has to be everything, everywhere, all at once. Incredible. Any country like India does it, it will be the next economic miracle after China. In that context is where DPI thinking has to be relooked at, upgraded, and there's several questions that only you can answer. How do a combination of DPIs compound? How do I not measure outcome, which is the final thing? How do I measure something as intermediate that tells us that we are going in the right direction? A lot of economic measurement happens physically. Therefore, the granularity of that is different, the speed is different. In the digital age, can you measure throughput and not just output? UPI allows to do that. Uh, Shivnath is there. Pulse from PhonePe is an example of how you don't need to measure annual data once a year. Real time, I guess. You can figure out how money flows are happening. Just think of somebody is able to correlate that to GDP. Can you predict things even before the national government brings it out? So, a lot of those possibilities are there as the world is getting more and more digital, as data is available more and more. We are practitioners. For us, it's the hard yard of the political battles, the coordination, stakeholder management. Technology is important, but that's the easier thing. We do not have the bandwidth to step back and ask the basic questions that some of you can. So I would like to end on a note of my one favorite peeve against researchers. You do the research after the game is over, which is okay. I mean, I'm sure it is needed, but can you help and participate while the game is on versus analysis of why someone won or lost a game? That to me is the real collaboration, and which is why I'm really grateful that Manish, Suresh, and all have taken this on. As and those of you who've not seen their first podcast, highly uh, recommended. Plug, Suresh. Which is NCR is at the intersection of policy, priority, and economics. Right? Research. Can you be at the forefront of this journey along with those who are building it, rather than as the rear, bringing up the rear once the battle is done and dusted? You need both. The second is easier. The first is where India has an opportunity to innovate, and I would end with that request to you. Thank you.
Thank you, NCAER, Ravi, and the organizers for inviting me to present my work. I will start off where Shankar left. We would be very happy to collaborate. We also want to look at the causal impact of DPI. What we are hungry for is data in partners. We do reach out and meet stone walls often. So what I'm going to talk about is three things that Kamya and Shankarji mentioned, which is composability, combination across technology, discoverability, which is about information asymmetry, and non-linearity in technology. The question that we are addressing is very, very simple. How do we expand access to credit to a large mass of people who have historically been excluded at scale and without increasing default risk? Some numbers to just highlight the scale of the problem. About 1.4 billion people still lack bank accounts around the world. This number used to be 2.2 billion in 2012. So the drop is largely coming from the Jan Dhan Yojana accounts and the banking for the unbanked program started in India. The challenge is that despite having access to bank accounts, credit remains elusive for a large mass of this population. And the claim that we are going to make in this study is that no one technology solves the problem. It's really the complementarity between financial technology, which is savings account, combined with DPI, where we see some green shoots of this problem getting solved. So now, let's take a step back. Why does this market remain excluded in the first place? Two obvious reasons. One, probably it's not lucrative enough to serve. If I need to give a 5,000 rupees loan, I still need to do KYC. I still, in the previous world, the non-digital world, I still needed a loan officer to go and talk to the person, fill the forms, etc. So unit economics did not work. The second, and probably a bigger problem, is information asymmetry. How do I discover borrowers who are creditworthy? How do I screen them? Do I even have the data? By design, they are stuck in a bad loop. All of you have a credit score. You apply for a bank loan. The bank looks at your credit history. There is a credit history, so you get a loan. Now imagine a person who doesn't have a credit history. There is no digital trail of financial or economic history for them. They apply for a loan. Credit bureau gives us a null. The bank doesn't give them a loan. They're stuck in this loop. So how do you take them out? And what I'm going to argue is that these two frictions, no one DPI layer or bank account is going to solve. Different aspects of DPI solve different parts of this friction. So Aadhaar eKYC, according to some IMF estimates, significantly brought down the cost of know your customer process. So now unit economics start making sense. But then how do this large mass of people build a digital trail of financial income that is verifiable by banks and fintechs and other kinds of lenders, so you can assess their creditworthiness better? And that is where the UPI rail is going to come in. UPI also acts as a rail for recovery of this loan. So instant delivery and recovery both, again bringing the costs down. So the big picture is that no one layer solves this problem. If we really want financial access at scale, it is a combination of technology that leads to magic. Now, so we started out by looking at, so this is a series of work I've done on financial inclusion in India. We started out by looking at Jan Dhan Yojana program, the largest banking program in the world. And we did a lot of white papers from World Bank, IMF, BIS, that you give people bank accounts, great things will happen, productivity will go up. And this is the largest banking for the unbanked program in the history. We look at the data, it has some effect. People start saving better. So the savings go up during good times. They draw down on the saving during bad times. There is some liquidity management. But it doesn't open pathways to credit. It doesn't open pathways to insurance. There is no aggregate effect on the GDP or local economic activity. So it was quite depressing as a finance professor, for sure. So bank accounts become necessary, but they are not going to be sufficient. So then we started thinking about, why are banks not lending to these people? The unit economic problem is somewhat solved because the fixed cost of acquiring the customer is there. Now they have bank accounts. So maybe the challenge is, one reason these people did not have bank accounts is because they don't have savings and they are employed in the informal sector, however we define it. So they get a lot of the payment in cash. So how do you verify anything about them? Are they credit worthy or not? So the question, then we worked with a fintech in India, which is now quite big, in 2018, on using alternate data captured from their mobile phones to examine if this digital data, which is, how many people do you call? How many people are there in the social network? How long do you call them? Along with what kind of apps you have, how much time do you spend on it? Can it be a substitute for credit bureau score? And the idea is the following. A lot of people don't have a credit history, but they do have a digital history. They are on smartphone, they are engaging with the online world. Can this digital behavior help us predict the financial behavior as well? And it turned out that it does a fairly good job, especially for people with low credit score or no credit score. And so the fintech that we were working with, 17% of the borrowers that they were denying credit because of a lack of a credit score were now getting approved. But there remains a challenge. All this paper showed is that alternate data can help in coming up with alternate credit risk assessment, and so the market can expand. But there is a cold start problem here. For the large mass of people who still don't have even digital data, how do you enable them to create a digital trail of history? And luckily for us, UPI enters and UPI becomes that engine. The idea is kind of simple. I was, let's say, there is this panwala right outside NCAR. I was a panwala. I was accepting payments in cash. It was not verifiable earlier. Now I have UPI. At least part of my income or inflow is coming from digital payments. That become a record, a digitally verifiable record of my income stream, which both banks and fintechs technically can now steer to measure my income and expand credit. So that is for the people who were underserved. Even for the people who were served, on top of Aadhaar, which already brought the KYC cost down, the cost of serving these customers went down. Now I have something called a Google Pay, where I can go and apply for a small ticket loan, even as a prime borrower, get the loan approved instantly, make the payments back through the app itself. So the prime segment also gained as a result of this cost, the cost of serving customers going down. And it turns out that if you look at NPCI's recent transaction categories, debt collection agencies is the largest category. So loan recovery process is the single largest transaction categories. About 94,000 crores of credit has been recovered through that. Now, I will, as Kamya mentioned, our job as economists or academics is to prove causality for this audience. I will not focus on that. In our study, we focus a lot on trying to prove this is really a causal effect. I'm showing you a very simple correlation. Each dot here is a pin code. On x-axis, we have the amount of UPI transactions. On y-axis, we have the number of credit accounts. And it is a massive data collection exercise, by the way. We have data access from CIBIL Credit Bureau on the universe of consumer loans given in India, not identified at the pin code level. We had to get UPI data at the pin code level from another party. We had to get data on Geo 4G internet towers, 4G towers being installed from TRI, and then bank accounts, Jan Dhan Yojana bank accounts opened across pin codes. And even with that, we just barely start scratching the surface. So the simple correlation that we find here is that a 1% higher UPI transaction at the pin code level is associated with 0.7% increase in credit or higher credit at the pin code level. I'll call it increase because I think we do a reasonable job of proving that this is the causal effect. And these are three summary numbers, aggregate statistics that really narrate the full picture. So there are three kinds of borrowers here. You have prime borrowers who already had credit, low credit risk. You have subprime borrowers, they were also included high credit risk. And you have this new to credit category. If you look at prime, this is where the unit economics is playing a role. Both banks and fintechs start increasing, and most of this is coming from small ticket loans, by the way. Small ticket loans to the prime segment. For subprime, fintechs actually exceed in the higher risk category. The number of loans given by fintechs, not the value, is more than banks within a span of 3 years of launch of UPI. Some similar pattern with new to credit as well. Within a span of 3 to 4 years, the number of new to credit customers served by fintechs collectively is more than all the banks put together. Not in value, only in number, and all of these are small ticket loans. If you look at banks, they remain flat. So they can use the same rails and they can also expand credit to this due to credit segment. But banks are focusing on prime, a little bit on subprime. Fintechs are leading when it comes to new to credit. Now in aggregate numbers, banks base is higher. So a small delta with banks still matters more. But in terms of absolute numbers and the growth, fintechs tap onto this technology. They are more agile. They are the ones who start reaching the new to credit. So take this number with a pinch of salt because this is coming off a very low base. Prior to UPI, fintech lending was practically non-existent. It really picks up with the launch of UPI. Across all categories, due to credit, subprime, prime, there is a massive growth in fintech credit, mostly in the small ticket segment. The key point is banks really don't expand credit to this segment, despite with us having state-owned banks with at least some mandate of having social welfare. The point here is that this due to credit is gaining both from unit economics and the fact that they now have a verifiable income stream. The prime segment is primarily gaining because the cost of providing the small ticket loans have gone down. Now, where do these effects concentrate? And here is where complementarity really matters. Most of the increase in new to credit loans is really coming from Jan Dhan Yojana areas. So areas where there were more number of banks accounts opened for the previously unbanked JDY accounts, new to credit small ticket loans is primarily concentrated there. And aggregate increases in credit primarily by fintech is in areas which got early access to Geo. So it's really the combination of bank accounts which acts as a base substrate married with UPI, married with 4G cheap internet, that makes the magic happen when it comes to credit access. Obviously, we can't comment on the outcomes. We need more data to link what people are doing with the credit. But what we can comment on is whether default rates go up. So, see, in aggregate, a mass of people that never had access to credit, it's a risky segment. If you lend to them, aggregate default rates are going up, are going to go up. And that's not a bad thing. That is what experimentation means. Over time, models will learn, banks and fintechs will learn. But what we are doing here is comparing areas with high UPI usage and low UPI usage. High UPI usage areas are the ones where the credit growth, the fast credit growth is happening. There is no differential increase in default rate across areas. So our interpretation is that the combination of this DPI and particularly UPI in our case allowed fintechs to reach borrowers that were creditworthy but underserved, what we call invisible prime in the academic literature. So credit expands with not much rise in defaults. Now, to conclude, how technology will play out in the long run is very difficult to predict. And now you have multiple layers of technology. You have DPI, Kamya also talked about AI. The interaction between them is non-linear. Once you build the race, the interaction is what makes things happen, and it's very difficult to prove and predict ex ante. The next frontier is data sharing. It started just starting to pick up since 2021. I have some ongoing work looking at the role of account aggregators, in particular on access to credit for females, but challenges remain. One, even with the massive success, UPI penetration has flattened. The most optimistic estimate would say that 50% of adults in India use UPI. The least optimistic would say maybe 30 to 35% use UPI, but we have not been able to go past that saturated levels. RBI is obviously worried about whether consumers are getting over indebted. To understand that, we need to understand what are consumers doing with this credit, what is changing in their lives, and there is OSEN and ULI. One concern, despite being a DPI optimist I have, is at some point we need to define the boundary between what is infrastructure and what is technology that private players can innovate on. Because ultimately, this requires continuous innovation. We are moving towards a world of AI, agentic e-commerce. DPI needs to evolve. One, to reach the last mile, which gets tougher with each layer that you reach. But also, in this world of rapid innovation, can quasi-government bodies keep pushing the boundaries of innovation, or do we really need private players to come in? And at what is the boundary between technology and infrastructure? Do we need to make a competitor for Uber? I don't know. Best left to policymakers. Thank you for your patience.
All right. Thank you very much. Thank you for including us in the program. I'll talk a little bit about financing. I'll talk about decentralization. Unlike Shashwat, I'll talk about one paper as opposed to four. I think usually I have a hard time covering one paper. I'm not an expert in platform economics. I think there are a lot of people who know much more. I'll talk a little bit about tokenization. And as a true academic, I'll do the presentation. Difficult questions. My colleague Vasundhara is sitting here. She'll answer them. So this is joint work with Vasundhara, who is at ISB with me, and Vineet Kumar, who's a professor at Yale. We look at the role of financing in token economy. We want to understand what is the impact of peer credit, specifically for platform outcomes, for sellers, for buyers. Now, what is tokenization? Tokenization is the process where ownership claims to both physical and digital assets can be represented by tokens on a decentralized blockchain. So, this is where we do have some flavor of decentralization, we do have some flavor of public ownership, but all of this is done on a blockchain. Now, tokenization does a few things. First of all, because we are taking these digital or physical assets, we are creating tokens for them, individuals can actually buy some part of these assets as opposed to whole assets. What does that mean? I can take a real estate, I can take a piece of land, create a token out of it, put that token on the blockchain. Now, instead of buying the entire Empire State Building, you can own a fraction of it. Right? So
Tokenization enables fractional ownership. The second thing that tokenization does naturally is enable financing or lowers the cost associated with financing. Not only the cost, it also lowers the risk associated with financing. Why? Because everything is written in smart contracts on the blockchain. What that means is these tokens themselves can be collateralized. So if I need a loan, I can collateralize the token itself, I can get the loan, and upon payment of the loan, the ownership of the token gets transferred to me. If I do not pay the loan, if I default on my loan, then the ownership of that token is transferred directly to the lender, and all of this happens seamlessly. What this also does then is it enables individuals, people like you and me, to offer loans. We do not need banks, we do not need NBFCs, we do not need a regulatory body to offer these loans. These loans can be offered by individuals. Why? The contract is written in the blockchain, the contract can be seamlessly enforced. This is the setting that we are interested in. We want to understand the impact of peer to peer lending, where loans are offered by individuals to buyers through sellers who are selling certain digital assets. We want to understand what are the impact of offering these loans on a platform's outcome. Now, again, I've talked about tokenization. Why do we care about tokenized assets? Tokenization is widespread. And when I say widespread, we have over 560 million users. By 2030, the entire Web3 platform tokenization market cap is predicted to reach about $2 trillion. Tokenization is redefining several categories. The most common ones, things that we are aware of, yes, we know digital currency, cryptocurrency. We also talk about non-fungible tokens or digital art, for example. But in addition to that, open finance, marketplaces, gaming, real estate, so firms such as Realty, stocks, for example, securitize, they're changing the way how businesses are conducted on a decentralized platform. So this is where we see a potential opportunity to understand how financing can impact tokenized assets and the platforms on which those assets are traded. The key research question then is to look at the platform outcomes. This would be quantities, prices, revenue, understand how these change in response to availability of financing. The study is going to be situated in the context of non-fungible tokens. So think of it as a case study for non-fungible tokens, but the findings that we have can be generalized more broadly to all of tokenized assets. Beyond just looking at the aggregate outcomes, we want to understand whether a platform can use tokenization to grow, use financing to grow, and whether the effect of offering financing differs across different types of users, and the distribution of assets which are traded on the platform, or the composition. Right now, like Shashwat mentioned in the previous presentation, when you make financing available to people who are not only in the system, new people come into the market, that changes the distribution of people who are availing loans. Same thing would happen over here. When you offer financing, not only could new people come into the market, but because new people come in, it could also change the type of products which are traded on the platform. Finally, putting on my hat of an econometrician, I would like to understand the impact of financing on both the supply side and the demand side. The demand side over here focuses on the consumers, on their likelihood to purchase, and the supply side over here is about the seller's likelihood to list more of these assets on the blockchain. Right, so very quickly I'll jump to the institutional detail over here. In the context of non-fungible tokens, there are 2 or 3 major platforms. OpenSea is one, Blur is another. Then there are smaller platforms such as Rarible, Magic Eden, and so on and so forth. Blur, one of the biggest platforms, enabled financing for 13 of its collections of NFTs in the profile picture category. What does it mean they enabled financing? Financing was enabled through peer-to-peer lending, which means individuals like you and me could actually offer loans on the platform. As a user, when I'm buying an asset, when I'm buying an NFT, I could avail of these loans. If I pay off the loan, the NFT gets transferred to me. If I default on the loan, the NFT is transferred to the lender. The loans over here are tied to particular collections. So as a lender, I can say, I want to offer a loan for, let's say, a collection called Board Ape Yacht Club. Anybody who's buying a token in that collection can use this loan, right? These loans were offered for these collections over time. So there was a staggered rollout between May and December 2023. Again, the collections which are chosen, 13 of the top performing profile picture category collections, are not random. These 13 collections account for about 51% of the platform's revenue. Right? This poses a challenge for us to understand the impact of financing, something I'll talk about in a little bit. But what this also means is because these 13 collections account for 51%, and we'll add some more collections to our analysis, we cover more than 80% of all of the platform's revenue. So any findings that we have go beyond just the collections, and we can generalize them to the platform at large. So the data that we have 52 weeks of data from January to December 2023. In this data, we have transaction level information for these 13 focal collections, as well as 36 other collections. We call them the control group collections. You'll see why so. And these collections go beyond just profile pictures. We have gaming, we have art, we have membership. There is detailed trading data for these collections for all individuals across both Blur and OpenSea. We observe the same consumer purchasing across both platforms. We observe multi-homing, so that allows us to say something about whether new people are coming to the platform or not. Right? Just to give you a little flavor of what the data looks like. So what I have over here are the quantities sold for the NFTs at Blur and at OpenSea. The blue line over here, actually this is better. The blue line over here is what we call the treated collections, which is the 13 collections for which financing were made available. The red line over here is for the 36 other collections. We see very different patterns at Blur and OpenSea. In both places, if you look at the red lines, they follow a very similar pattern at both platforms. The blue curve at OpenSea right over here, where financing was not enabled, the blue curve trails, or not trails, but overlaps somewhat with the red one, meaning when there is no financing, the treated collections, their sales are very similar to the control group. But when financing was enabled at Blur, the treated collections behave very differently. Our job then is to say that the effect that we see over here is a causal effect of financing on platform, on revenue, on quantities. This is where we run into a bunch of issues, right? I mean, Ananda showed an equation this morning, so I feel much better showing this equation, which is quantity, prices, and revenue is a function of financing, right? So the problems that we have, either a collection had financing enabled or it did not. In an ideal world, we want to see the same collection with financing enabled, without financing enabled, but we don't have that counterfactual, right? We are going to use those 36 collections as control groups. The financing was enabled for the top performing collections. Again, these collections are systematically different. We'll have to account for that in our analysis. There were multiple collections which were treated, and this collection treatment happened over time. So there's staggered timing, which could lead to some dynamic effects, which can create a problem for us. And lastly, the treated collections and the control group collections, collections for which financing was made available versus those for which financing was not made available, these could be very different and violate the parallel trends assumption. To address all of these concerns, and in the paper we go into a lot more detail, But to address all of these concerns, we carefully choose a set of control group collections and then use a synthetic difference in difference approach, which was proposed by Arkhangelski and co-authors, which addresses a lot of these issues. I say a lot because it does not address all the issues. One of the most tedious one over here is a potential violation of the stable unit treatment value assumption, or SATVA. The problem over here is a same consumer or user could be trading in a collection which is financed or has financing enabled, and a collection which does not have financing enabled. Meaning the same user is exposed to financing and not exposed to financing. That violates Sattva, that invalidates everything we do. So we do a bunch of robustness checks by eliminating overlapping users, eliminating different control group collections, and so on and so forth. The findings that we get are robust to these alternate specifications. So very quickly then, what are the findings? In the last minute and a half, I'll briefly talk about what we find. We find that peer-to-peer financing does lead to an increase in quantity. Now, why is this surprising? You make financing available, it should increase transactions. Well, not with peer-to-peer financing, because as a lender or as an individual, I could either purchase an asset or I could use that money to offer a loan. And if I'm using that money to offer a loan, the transactions could actually go down. So with peer-to-peer lending, whether the quantities sold increase or decrease becomes an empirical question. We actually find that the quantities sold go up by 49%. We also find that revenue goes up by 300%. So if quantity goes up by 49%, revenue goes up by 300, you would say prices have gone up. That is what accounts for the difference. Turns out we don't find any difference in prices. We were intrigued by this finding about why prices do not change when revenue goes up a lot more than quantity sold. And the answer to that is there is a compositional shift in terms of what gets sold. We find that users use financing to alleviate their liquidity constraints, and they do so by buying higher quality NFTs. They do not buy lower quality NFTs. They do not substitute away from them, but they just take all of that money and buy higher quality NFTs. We do not find that financing is able to attract new users to the platform. So yes, financing is good. It is increasing sales, but all of that increase is coming from existing users. So a platform can increase its engagement among existing users, but it cannot attract new users from other platforms. We don't find any evidence of spillovers. A concern that we had was there might be spillovers to the competing platform, OpenSea in this case. We don't find any spillover effects. And the last part then, focusing on how much of this increase is coming from the consumer side versus the seller side, we find that 69% of the total increase in quantity is driven by consumers being more likely to purchase when financing is available, as opposed to sellers being more likely to list these NFTs for sale. Right? So in summary then, tokenization creates an opportunity to enable peer-to-peer lending. None of this would have been possible in the absence of tokenization. Financing does help a platform. It increases the sales and revenue without distorting the prices. And we see a shift in the distribution of NFTs which are sold. We do see people, consumers purchasing higher quality NFTs. Thank you very much.
All going no mic? No. Thank you so much, Pranav, for a lovely presentation. We can I actually had a number of questions as I was listening to a lot of these very deeply researched kind of double clicks. Maybe, Shashwat, I'll start with you. As you framed in a couple of your papers, you said, look, we're looking at alternate data, and alternate data was effective. I'm really curious to double click when you say alternate data. That means a lot of things to a lot of people. Is it digitally signed videos of the factory that they're working in? Is it evidence from another app where they're able to get data sharing done? So how did they actually access that alternate data, and what kinds of alternate data are you talking about that actually make an impact?
So the alternate data paper was just, your smartphone data. How many SMSs you get, from whom, how many people you call, for how long. That turned out to be the biggest predictor. Obviously, in prediction, there is no causality, but we interpret it as some form of social collateral. So if you have a large network, they know that you have deep network with somebody. If you don't pay back, they will call them and harass them, or maybe try to shame you. So that data was very simple. If you ask me about what I envision, I think I envision everything: your employment record, your consumption pattern, because I can price insurance better to the extent that I provide my consent, my education records, income tax records. All of that is not available. Most of what it is being used is really right now bank transaction data, and which is where UPI comes in. For people who did not have bank transactions, now there is some data uh, uh, available. I know that there are AI companies which are recording people and trying to create an AI version of that. I feel very uncomfortable with that idea.
Wonder why. No, interesting. I think double clicking the fact that even your SMS text, the volume of texts, so is a powerful predictor, is a very interesting kind of observation. Um, I think maybe like Pranav, you're talking about lending too, but totally different angle, right? Like it's non-institutional lending. You're saying peer to peer. And I think everyone in this room has probably engaged in peer-to-peer lending. We're all supporting probably household staff members or people that we don't. When you're in India, you can't avoid it. I mean, but the peer-to-peer lending that we do is so deeply informal. Now today we'll use, let's say, like a UPI to make that payment, and you might maybe use e-mandate UPI to collect it. But do you actually envision that tokenized peer lending could be implemented in India? And if so, under what conditions? Because there's truly a market for it, and it's very clear that it's already a behavior.
Yeah, so I agree. There is a market from it. I come from a family of money lenders, so
Suddenly, everything makes sense.
a lot of money is exchanged in the informal sector. No, that's why I ran away from there. So a lot of money is exchanged in the informal sector, right? But that whole system rests on trust, right? That whole system rests on trust. What we are talking about here in terms of tokenization is creating that trust by decentralizing everything, not having certain people or individuals as owners or gatekeepers, right? Right now, if we think about the lending sector, I would go and lend to somebody who I know or somebody who I can arm twist into paying me back, oftentimes without a collateral. Now we are talking about lending where the token or asset itself is a collateral. We are not talking about loans which are given to people in the absence of collateral. So there is a recovery mechanism. The recovery mechanism is centrally enforced. Uh, the question that you asked, the second part of that is about adoption, right? I think adoption is a more of a behavioral mechanism, right? Much like when we think about UPI, one part of it is creating UPI, putting it out there. The second part is how do you make sure that people are using it? In the context of UPI, there are huge network externalities. The same thing would extend to the blockchain, the same thing would extend to tokenization.
Yeah. No, I think that would be very interesting to explore at an national India level. But in the meantime, I think, Shashwat, if going back to you, I think the banks are, the lowest interest rate that you can find, right? So ultimately, while we do support fintech lending and, NBFCs in the space, there is a demand to say, why can't I get my 4 to 5% SBI loan to reach the most deserving customer? So do you think that this journey of like the alternate kind of financing, the newer, let's say, fintech style NBFCs, do you think them building a credit history is actually going to influence the banks? Is it just like a maturity cycle of an individual? Or do you think that, if they had to bring on these customers, they would have by now, and so we can't expect it to happen in the next 5, 7 years?
I mean, so it's a mix of both. There will be people who will be able to graduate from fintechs to banks. Now, there's a reason banks are not lending to this segment, right? The business has to make financial sense. We all have this heuristic idea that 10% is low, 30% is high. Ultimately, interest rate is a function of the risk and the cost of providing that loan. So, in the US, many states have these caps on payday lending rates. And payday lending rates are very high, 300%, 400%. What we observe is when you put those caps, the businesses run away, the lending stops. If it was really rent extraction, then you put some cap, the business is still profitable, they will not run away. So, it's quite interestingly, nobody has ever asked this question. How much are people willing to pay for credit? And I have a very nice, very cool paper on this. With a fintech in California, what they do is they provide people small ticket loans. So $50, $100, $200 backs, and it automatically gets deducted on your payday. They don't charge interest. They let people tip. So and half the people tip, half the people don't. But on an average, across the tippers and non-tippers, the cost of credit turns out to be exactly equal to what payday lenders do. So in my view, I think we at some level we need to trust the borrower to do the right thing for them rather than being patronizing and preventing them from accessing credit in the first place.
Yeah, no, that's entirely fair. I think they should access it from wherever they can. Shankar, I guess coming to you, I don't know if those of you know in the audience, but Shankar was the person within the UIDI team who actually named Aadhaar. So if you have an issue with the name, you know who to call. But Shankar, I think moving past a lot of the work that you did past Aadhaar and now at EkStep, one of the areas where you're taking on is sort of jobs, and this challenge of, okay, even if we can identify or solve credit, how do we unlock opportunity, right? So can you tell us a little bit about this discovery approach that you're thinking about for jobs, and are you taking on LinkedIn? That's the question.
Absolutely. Yeah, thanks.
Yeah.
Yeah, so when we think jobs, we think of LinkedIn, we think of white collar and all, but that's a minuscule percentage in India. The real thing is where somebody wants some kind of a job within 10 kilometers of where they are, most likely informal. Most likely, both the job seeker and the job provider speak in the local language. Most likely, both are not digitally savvy to the extent we think. Write a CV, write a job description. So, when we shift the gaze away from white collar to India's ground reality, the situation is completely different. In Hubli, there was a gentleman who was he was running a small industry. He was looking for people with a certain background and he was not finding them. Just 800 meters from his house is a ITI. He did not know about it. Why? Because he hits the highway, turns left, and goes towards his factory. If he had turned right, he would have seen it. It is right in front. It's as silly as that, right? Imagine our world before these food apps came in. You don't know what's around you. So how do you signal that I'm looking for a job? How do you signal that I'm looking for people? And then they're not looking for coders and high-end stuff. They just want a salesperson, a repair person. Especially in the case of girls, they don't want to go more than 1 or 2 bus stops away. Their parents will not allow them. So that's the kind of world where we're thinking, how can these people be ready? So an experiment in Ghaziabad, done with the local district officials, where all job sites put together showed this blue collar 100 jobs available in Ghaziabad. The district collector said, no, I have more jobs. I know that. So 3 months later, and this blue dot approach, where you use AI to, I'll explain that in a moment, 100,000 jobs became visible.
Wow.
100 to 100,000. What happened? Through AI, a job seeker could explain in their local language, this is the kind of job I'm looking for, 15,000 rupees, nearby, is there anything? And the job provider is saying, yeah, this is the kind of job I have, 15,000 rupees, here where I am, here's what I'm looking for. Once these two become visible, then they can find each other and the rest of the process happens physically. So rather than approaching it as a watered down version of the white collar job search, can we start ground up, acknowledge the realities of what's happening? How do you do it at the scale and complexity of India? That's where the DPI challenge is, and that's what is being worked on. It's very complex, but there's just some early breakthroughs that's happening.
Wow, that's very powerful in that it doesn't seek to digitize the whole journey. I think something we've learned from the DPI journey as well is that the best mode of digital is phygital, where where for many individuals you can access it self-serve on your app, but in case you need a physical touch point, there is an ability to pick up a phone, engage. For example, for Aadhaar Pay, you have a doorstep visit to access your pension, and you can just give your fingerprint at your doorstep. So DPI is working, but it's sort of a mix of physical and digital. Have you seen that in your work too, Shashwat? The power of combining physical and digital, and is that I'll come back to this question. Is that why you're not a big fan of Oken or ULI? Is it because you think they're purely digitizing something that could be a mix of physical and digital?
I mean, ULI has some role. It standardizes the data sharing layer, and it has to pick up. No, that's not why I'm concerned about that. I think we at some point have to define the boundary between what is infrastructure and what is in the domain of private.
What do you think the boundary is?
I don't know. We you define the DPI quite well. I think you need to also define the boundaries for us. So in terms of digital, I mean, I don't have research on it. But whenever I talk to fintechs, all of them claim, especially in the lower income states,
Yeah.
just digital doesn't work. You need somebody to have a physical presence, and so the expansion is happening through the combination of digital and physical. So I think for now, digital is the way to go.
I see you're shaking your head though, Pranav. Do you disagree? Tokenization is
But I was nodding.
digital.
I was nodding. I think the physical part goes back to the trust argument that I made, right? You can create all of this infrastructure, but for a layman, putting their money in an ATM machine which disappears, they don't know where that money went, right? At least back in a day, now things are better. I can create this infrastructure, but how do you get people to trust the system? And that is where having those local agents, people within your village who come to your doorstep, who talk to you, that makes a big difference. I mean, we were working with one of these MSMEs, NBFC, which was offering loans to women entrepreneurs in rural India. One of the big issues we had was about trust, right? Because they had their sales agents who were males knocking on doors and asking for the daughter-in-law, right? And in villages, nobody wanted to have their daughter-in-law come out talk to a stranger. So that is where we also got women salespeople. So I think that trust goes a long way, which is where the combination of physical and digital comes in. The technology will take on the back end of it, but
Yeah.
at the front end, you need to build that trust.
So not so DPI is the summary of today. But thank you so much, everyone, and lovely to hear from you.